Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guests are Steve Wolfe and Nate Grossman, co-founders and partners at Growth Street Partners. Growth Street is a growth equity investor that offers practical funding for early stage B2B SaaS companies that are already up and running and know they're onto something, but need a little bit of fuel to grow faster in a practical way. So growth equity funding is not like VC funding, and it's not private equity investors as well. So we're going to talk about what is growth equity investing. When is it appropriate for practical founders to increase the enterprise value? When is it good ROI for founders? What kind of founders does it make sense for? And what Nate and Steve are looking for in the partners they have served. And they have served many practical founders who've been on our podcast already. So you're going to hear great stories and examples of how practical founders have grown and leveraged a little capital to grow faster and make a more valuable business. It's a great episode. Hey guys, we're live with Nate Grossman and Steve Wolfe of Growth Street Partners. Welcome to the Practical Founders Podcast. Good to see you guys.
Thanks for having us.
Good to be here.
Yeah, we got two of you here, so you have to pace yourself here on the phone here. You're both co-founders of Growth Street Partners, a growth equity firm based in San Francisco. I saw you a month and a half ago when I was in town for the Vertical SaaS event there. You guys have big smiles on your face. I run into you on the trail, and we've talked a bunch through the years here. Are you guys like Silicon Valley, San Francisco people, or why are you out there? Steve, are you from the West Coast?
So I grew up on the East Coast and moved out to San Francisco in 2009. And I'm definitely not a Silicon Valley West Coast guy. I think when I'm walking on the streets, I'm weaving around people because everybody's so relaxed out here.
Yes, right.
I got the East Coast edge. Yeah.
Yeah. Yeah. How about you, Nate? Are you from the Bay Area?
I am from the Bay Area originally. Yeah, born and raised, so haven't gone far.
Okay. Well, your office is downtown, but you guys are practical investors. We were just talking about this. You're helping to buy companies, but you're the investors that buys them, and it's not really a buyout firm. It's the growth equity game. So, that partial exit, the founder gets to take a minority or majority sale, take some money off the table, and you guys are investing. And it's very practical game. So I still think growth equity is part of the practical funding spectrum out there. We're going to talk about everything growth equity. It's late in 2024. The world is still changing. Let's just get in the neighborhood of what is Growth Street Partners and what's your focus and what do you do, which isn't for everybody. And then we'll talk about everything growth equity. Steve, why don't you start? Get us in the neighborhood of what is Growth Street Partners.
Yeah, maybe I can tell you a little bit about Growth Street and what kind of investing we do. And then Nate can tell you a little bit about how Growth Street started. So Growth Street, we're currently investing out of our second fund. First fund was 70 million. Second fund's 130 million. We invest exclusively in vertical B2B SaaS and tech-enabled services companies, typically where the founder comes from industry. So in some form or fashion, they live the problem their business now solves. We call it founder market fit. We're investing $5 to $15 million for 20 to 50% of a business. So less than 20%, the entrepreneur, we think they just want money and not a partner. And more than 50% at this size range, call it 2 to 5 million of annual recurring revenue. They know something that we don't know about their business or their end market. They shouldn't want to sell that much of the company.
Well, blow my mind here, Steve. You already said something I'm not likely to hear from super smart investors that see a lot. The founder may know something that the smart investor doesn't know. I don't hear that a lot from founders about their PE, private equity partners in there. So maybe you could talk a bit about that. Maybe there's a friendlier approach here on the growth equity side and what you guys do.
Yeah, well, so the foundation of Growth Street is about founder market fit. So the founder came from industry. They live the problem their business is now solving. They understand their market and their customer better than anyone, right? And we'll get up to speed really fast. We'll learn about their industry and about their customers, but we'll never know it as well as they do. And so that makes for a wonderful partnership, right? Where we bring something that they don't have, and they certainly bring something that we don't have. So that entrepreneur that knows more than we do, if they are at 3 million in revenue and they want to sell 80% of their company, we're like, what the heck? There should be so much opportunity in front of that company. Why would you want to sell that much of it?
So it sounds like the founder wants to get out and cash out and,
the alternative is that maybe the business is really sound, the market's really good, but I mean, maybe they had a terrible fight with their co-founder or a brutal divorce, something that allows this new investor to own more than 50% of the business. And then all of a sudden we're diligencing things that have nothing to do with the business. And that's not a place that we want to be. We want to spend our time thinking about how can we help this entrepreneur accelerate their business?
Yeah. So growth equity, I've always explained it. It's not private equity like the final resting place and the people show up and tell you what to do and they have their playbooks and big money and they'll grind the business out and so forth. And it's not venture funding, which is splash money on a rocket, push the rocket ride, and it may or may not work. You're kind of in between. Your growth side, you're investing in founders. You're not trying to run the business for them. And you guys come in pretty darn early. Nate, why are you guys in so early? Most private equities wait until 10 million ARR, at least some growth equity gets, but you're down there pretty early, 3 to 5 million ARR.
Yeah, we're biased, obviously, but we do it for a number of reasons. We think it's a stage of partnering with these founders where, number one, we can be really helpful. And we can really help them as they think about putting in place the processes and systems in their business to get to that next level of success. And it's a really fun time to partner with these founders and be in the trenches with them, where we're then working with them to get to that life-changing event. And that's a pretty special time to get to work with these folks.
Yeah, we joke internally that, we want to get these entrepreneurs to the estate planning event. Right. But
life-changing wealth. Yeah.
The event that we're a part of is like a true growth equity round, right? Like it's a true growth equity investment in that a lot of the money is going on the balance sheet of the company to help them grow. And if we're successful in doing that, that next event is going to be the real life changer.
Okay, so
multiple events.
Yeah, so this is, I've got a growth company. I got it past the startup stage and whoa, this is a little different. Nate, like you described, that inflection point of, oh my gosh, that startup to scale turn, right? Things look a lot different for CEOs, but they're not trying to take 50% out of the business and cash out, right? And win the big prize. But that's the secondary for founders to get a partial first bite of the apple, is so called. Is secondary a normal part of what you guys do at Growth Street, or is that less so, Nate?
It absolutely is. Yeah, a little over half of the 50% of the dollars that we invest go on the balance sheet, and a little bit less than 50% go as liquidity to founders who want to de-risk a little bit, and or if there's some early friends and family or seed capital in the business, there may be some interest in liquidity from those folks. And the founders want to give those early investors that supported them the ability to take some chips off the table if they want to as well. So it's nice to enable that. We think it's a really healthy thing, for founders to de-risk a little bit at this stage. And it allows them to look up more at the horizon as they're thinking about, the future of their business.
Well, if you bootstrap a business and your entire net worth is stuck inside your business and you haven't cashed out anything, Steve's big smile on his face. We know all the founders that are like this. It is life-changing to win partial prize and finally buy the house and get a really relief. Steve, I don't know if you came up with this years ago when we chatted, but there's the white knuckle game of, hands on the steering wheel and holding on tight. When you take money off the table, I've seen this hundreds of times with founders and keep on going, but it just takes the pressure off. You can actually see more clearly, I would say, than get out of survival, mode where if anything breaks, it's all going to fall over.
I think that there are like really discrete and tangible things that change when you take that liquidity, where, like when you're that white knuckled entrepreneur and your bank account is dwindling, you hire the person that's a little bit cheaper. You don't hire 2 salespeople, you hire 1 salesperson. And if that one salesperson doesn't work out, you miss your number.
Yeah.
If you hire two and one doesn't work out, you're okay. And so being able to not only have the cash on the balance sheet, but also to elevate your risk tolerance a little bit relative to the quality of your company and the quality of the company's performance, it can have really profound implications to your business.
So the kind of companies where you're helping, how many companies have you invested in and are working with and successfully? Is it
at Growth Street 15?
15 companies, right?
Yeah.
Yeah. So you're not a big firm. This isn't a big machine. You guys are both helping. You're both co-founders. You're both talking to every founder and working together.
Yeah. I think that's a big one for us is that, so 15 investments over 7-ish years. So call it 2 a year. We've had 8 liquidity events with 7 companies. So things are happening all the time. But it reminds me of Mike Martin, the founder and CEO of Hotel Effectiveness, when we were trying to woo him to take our money, Yeah. And he came out to San Francisco. We presented to him. He presented us. He's about to leave our office. And before he leaves our office, he puts his hands on our shoulders and he looks us in the eyes. And he's like, if we're going to do this, you better be all in. And we built Growth Street to be able to look him right back in the eyes and say, yeah, you're darn right. We're all in. Let's go. It's a really fun way to set up the firm to align our interests with the founders.
Oftentimes on this one, it's not just the founder doing that. It's the founder's spouse.
Yeah. Oh my gosh. We're behind them saying, seriously, people having those dinners. Yeah, I'm sure.
We've had multiple examples of that. We had Chuck Gibbs, who
Oh yeah.
Obviously, before he would allow us to partner, he said, we need to get dinner with my wife, Nancy, and she has one question for you. And if you get the question right, we can keep moving forward here. And if you don't, we'll see what happens. So we go to dinner or getting to know Nancy, and she says, all right, I have my question. And she says, what cars do you guys drive?
Oh, good one.
She's like, you're out there in Silicon Valley. If you have cars where the doors open up, this dinner's over.
Yeah.
Right. The old Silicon Valley HBO thing.
Greg, you have no idea how panicked we were when Chuck told us that his wife had one question for us. It was, yeah.
And what were your answers, Nate? What did you guys say? What kind of cars did you drive?
I think I was driving an Audi.
Yeah. So I at the time I had an Audi A3 e-tron, and so that was an acceptable answer. And now I have a Model Y, so a Tesla. My wife worked at Tesla for a long time, and I was embarrassed to get a Tesla, but my dad gave me permission. He said, your wife's worked at Tesla for a long time. It's good for the environment. Go for it.
Well, we talked about Chuck Gibbs, the founder of Childcare CRM here in Dallas, and I had him on my Dallas software podcast and met him. And this was midstream. He says, I've done a partial cash out. We brought in a different CEO. So I'm the founder, who visits, and the company's growing and it's doing all that. So we'll talk about Childcare CRM. We also had Deb Muller of HR Acuity on the podcast, who you work with as well. So these are practical founders who drive their Toyotas into the ground, right? And they really don't want to play the big flashy VC bet it all game. This is this is growth oriented, but it's a practical founder. It's reasonably crazy, right? To bring in a partner, take some money off the table, expect it to grow, and someday sell the rest of the company. So would you call it a practical funding game?
Yeah, absolutely. If you had 100% of your net worth in one stock and you went to your financial advisor, they would say, hey, you should sell along the way. You shouldn't sell all of it on day one. You should sell methodically and programmatically, and that's what we offer, right? We're coming in and saying, sell some of your company, but you want to bet on yourself still, bring in some help, bring in some capital. And then when that is ultimately successful, go do it again and again and again.
Right. Excellent. Well, Nate, you mentioned it a couple times, used the word, right? We're being invited in to invest, right? It isn't they're begging and you're saying, I don't know, maybe if we did, these are founders who built valuable companies, generally bootstrapped. So they're not desperate for the money. They're lean and mean and they have control. You have to earn your way in to partner with them, right?
That's 100% correct. Yeah, by the nature of the profile of, founder and company we're looking to partner with and how they've grown their business, to that point, they don't need capital. And so, we have to prove our value beyond just the dollars.
So they could want capital. Like if I had some money and I could see I could invest it in very prudent ways and get a very confident result out of it, they don't need 20 million in funding, right? What we're talking about is a few million or 5 million that goes to the balance sheet for them to spend more, something?
That's typically about right. The capital is nice. It can help accelerate things in the business. They can invest a little bit ahead of the curve, be it in hiring or in other areas of the company. They can experiment with a few additional things, to see what else might work. Beyond the capital though, it's founders that they do want to partner. They want a sounding board.
Right.
And that is the most important part of it versus the dollars.
Why do you say that? Just to be clear here, like the founder wants to be part of a leadership team and get professional advisory.
I think that's right. I think beyond that too, it's, the founder wants to get connected to, other founders across the portfolio, various things like that, they want to work with somebody that's kind of quote unquote seen the movie before, a vertical B2B SaaS company scaling. They also want to be able to call somebody on a Friday night when they're thinking about something in their business and they want a partner that will bring a unique, valuable perspective and that cares enough. Their company is important enough to that investor and that partnership is important enough to that investor that they'll pick up the phone, and not only will they pick up the phone, but they've also been thinking about the same thing, most likely.
Right. Yeah, that's really important for founders. And of course, I have my peer groups and I advise founders to be somebody who's not in their head, not in their building, saying, well, generally, and, for you, there's a bunch of ways you could do this and help them get through those kind of decisions. And Stephen, this inflection point where you invest, they're past the thrashing about of building a product. Is this the right customer? Is this the right product? And can we get it up and running? And they're having, let's say, more normalized but important scale issues, building the leadership team. Are they predictable companies yet? And they just need some efficient acceleration? Or what does it really feel like at that inflection point?
Yeah, yes and no. Like the clay hasn't dried yet, hasn't been put in the kiln. They definitely have something that's working. They haven't quite figured out how to scale it yet.
Yeah.
And one thing that I think is we've learned a lot from you, Greg, over the years, but one thing that these entrepreneurs have that it seems like you really teach is that when we invest, they've kind of figured out who they aren't. Early on, you're willing to sell to anyone, to talk to anyone, to take any meeting, and by the time they get to us, they're like, I don't sell to the teeny guys, or I don't sell to this industry, or I'm not going up and down Sand Hill Road anymore. And
trying to raise venture capital.
Yeah, exactly. Yeah. And so by the time they get to us, they know who they aren't. And we kind of help them figure out who they are, I guess, in some ways. But a lot of the times they know deep down inside, and we're just the inspiration, right? We're the motivator. So we're like the chief cheerleaders, sometimes. And then we're also the psychologists, where
therapists, right?
They call us up on that Friday night, like Nate said, and they're panicked about something, right? One of their largest customers has called them up and is screaming at them, and they call us because they think that we're going to lose our minds. And we're like, hey, let's come up with a game plan. Why don't you fly out there to see them, in 2 weeks, tell them all the things you're going to do. And before you know it, they've been talked off the ledge. And that's part of our job too,
Yeah. Well, are you focused? You talk about industry experience. Are you focused on vertical B2B SaaS companies that are industry focused with an industry expert? Chuck Gibbs at Childcare CRM came out of the childcare industry and he knew there was a slot for, tracking the new prospects and customers that were coming in and are so valuable, not on paper anymore at that time. But how many of your companies are vertically focused?
And maybe we can give a few more examples on this front to bring it to life, but it is a vertical focus, or we talk about a horizontal niche. And one of the ways we think about this is the market sizes for the companies that we're partnering with, it's a very different market size than the venture capital game, right? Where if you need to be Facebook to be a success, you need a pretty enormous addressable market to bring to life, more of the Growth Street style, and the founders and companies that we partner with. So another good example is Tim, based in Salt Lake City. He was an auditor and then in-house, at a company in the financial department. And he noticed that document exchange, when you're doing your audit, is incredibly manual. It's often, happening over email, and it's being tracked in Excel. And so it's also very insecure. And so he set out to build a software platform to solve this challenge. And that led to SureLink. He started it with a childhood friend on the technology side and his brother making phone calls out of his car into accounting firms, and, scaled it to over 2 million in ARR with very limited outside capital. I wasn't looking for capital, but I was open to having a conversation with us. And we were lucky enough to partner and helped maintain the growth rate on much higher numbers, which becomes more challenging. They actually even accelerated their growth rate with launching additional products. And then maybe just to bring it full circle, there was an initial bite of the apple with our investment in terms of liquidity, since recapped the business with a larger private equity firm. So
sold it again. We just
sold it again, and they did a majority recap. So sold over 50%, at that point. Another big bite of the apple. He still owns a lot of the company and he's on the board.
Can you give us an idea of how big in revenues they are, or was anything about the deal announced? I mean, can you get people in the neighborhood of how successful that has been?
They're 10 times-ish the size when we invested today. And they've done it, very efficiently. And now Tim, our most recent investment is another investment in Salt Lake City, where he is, and he invested alongside us and joined the board as an advisor.
Right. So this is something where VCs are all friendly until you're in there, and then you miss your numbers and it's not so fun anymore. And the end game is usually not very successful, but there are exceptions that we hear about and so forth. So, but that's an example of a partnership, and you guys were there through thick and thin with them, and he sold another part and kept on going. A 10x growth rate and a little payback out of that. He's got to have taken tens of millions out of the business. I don't know I'm not going to do the exact math or try to estimate it here, which is more founder equity value realized by this guy, Tim, than 95% of all the founders that raised big in Salt Lake City and didn't get money off the table and didn't end up owning much of their companies in the end, which is very common. Why didn't Tim take down capital from VCs in Salt Lake City? He knew about them. I'm sure they were chasing him. Why didn't he go the VC route?
He's a practical founder.
Okay.
To steal your line, right? He had plenty of VCs calling him, and what resonated with him, part of this is him, right? And who he is. And part of it is the business he had built, the market opportunity, how he wanted to go after that market opportunity. And
you didn't ask him to be crazy. I mean, Steve, did you say like 50% growth is good and you don't have to be unprofitable and right? Just keep compounding this thing and it ought to do great. And, I mean, we don't expect craziness.
Yeah, that's a part of the alignment, right? So and you, Greg, you talk a lot about this on your podcast, but, a venture firm, they might have 30 or 40 or 50 investments in a fund. Mm-hmm. And half of those investments are literally going to go to zero.
Yeah.
Literally.
Yeah.
40% of them are going to return capital, or maybe a little bit more than return capital, but not a good investment. And 10% of them are going to be insane. They're going to be Facebook.
Blockbusters. Yeah.
Yes, blockbusters. But the entrepreneur, Tim at SureLink, he has one investment.
Yeah.
His own company. And that misalignment of risk tolerance, there are certain businesses that are where it's appropriate to do that. But, 99% of businesses out there should not be, in the swing for the fences on every single decision you make, camp.
And he won bigger than all of his VC-funded cool kid friends out there.
Yes.
I spent a lot of time in Salt Lake and know Ryan Smith, who sold Qualtrics. That was a bootstrap success story that he started finally taking money off the table, sold it to SAP and went public. And now he owns all the sports teams in town. So isn't that ironic? But it's a very VC-funded town these days, between VC funds over there.
I think what's interesting about that, though, Greg, is like, so Ryan Smith, obviously, like 1 in a million or even crazier than 1 in a million. But Tim is probably 1 in a million too. But he's not going to be on the front page of the Wall Street Journal.
Right.
He's probably on the front page of the Utah Business Journal, maybe, who knows?
Well, we don't get to announce the public offering like that rings the bell that gets noticed. He probably didn't get to say how much he sold it for. But he's probably farther up the hill than all the VCs, with this house.
Yeah. More what I was getting at is that like Tim is, he's an exceptional guy. He is not actually an exception for Growth Street. There are a lot of founders just like him. And he decided to play a game where the odds were really stacked in his favor. Yeah.
Let's talk about that. Like, I think you're being generous if you say 10% are successful wins when a VC fund. And from what I know of VCs, and I know a lot of VCs and pay attention to that game, but you're trying to make every single investment you make success. And what are your odds? If 1 in 10 is the VC odds, are you 100% success rate, or that's your goal?
Man, we got to be knocking on wood like crazy here, Greg.
Yeah.
We're 100% so far.
Okay. Support for founders getting the second bite in the win that they expected.
Yeah. So, 9 investments in Fund 1, 7 of them, the first 7 of the 9 have all gotten to a realization event.
Oh, great.
1 of the 7 has had 2 realization events.
Wow.
And all the companies are performing really well. So it's been a wonderful time to invest in software companies. There's secular adoption of these businesses. We're trying our darndest to pick the Tims of the world.
So Nate, is it all in the picking, or do you guys have a little help to increase the success rate once you guys get involved? What do you do to help?
We talk about it at the stage that we're partnering with these founders and companies. Where we can be most helpful is increasing their execution capacity. They have something that's really working.
That sounds really boring, Nate. I mean, I thought you were going to give me some real big epiphany of, market expansion. And
that reminds me of the new PNC slogan, which is exceptionally boring, I think.
Yes, right. Execution. That doesn't sound flashy. Yeah, so I get it.
Yeah, exactly. And they have something that's really working, but they are under-resourced. And rather than, opine from afar about their business, but not really dig in and help and get involved, we can really dig in and help and get involved. And that's what's really going to enable them in this next phase.
So that was a dig at VCs who throw money at you and then they call once a month and
you picked up on that.
What exactly do you guys do to dig in? What will a founder experience with you guys? I don't know if you can speak for all growth equity investors here, but what kind of things do you do to help besides give a little bit more capital?
I mean, we had one recently, actually. We were all out in Milwaukee for a board meeting with Chipley, and they're really struggling with how to compensate their salespeople. They've actually never had an incentive program before, never paid incentive comp. They've just had base and then a company bonus. And they want to start having some level of sales culture there to enable the growth. And they were really struggling with how to compensate them and how to do it in a way that doesn't undermine the values and the culture of the business. Yep. And so it always starts in a spreadsheet because we're guys with calculators over here. We get in the spreadsheet, we go through it, we do calls with them and we talk through what they care about. And we try honestly to pull out from them what they see as really important in their business and what's going to make their business successful. And then we can help them tie it to the numbers. And, we don't actually tell them what to do. We enable them with the tools and have them come back and propose to us after that what they want to do. And invariably, they propose something better than we could have ever imagined, right? Because they have so much context and so much understanding of their market that that we frankly don't have. We try our best, but.
And they have a flavor that's working that they built of the culture and identity and system of their company, the DNA of the company, right? That is its own special thing.
Yeah.
Steve, what you said there was kind of in contrast to what I hear from practical founders that sell to a traditional private equity. Maybe they're a little bit bigger. The private equity guys show up with kind of the answer, and you kind of need to do it. And it's less fun that way.
Yeah, definitely. Like, I guess a few things. One is that we've noticed that when entrepreneurs are having fun, their companies do a lot better. Wow, shocker. And then the other one is when they continue to feel real ownership in their business and the success of their company, wow, they do a lot better too. So we set up the whole firm to enable that, right? We're investing down 20 to 50% of a business. So they still control the company, go to them with the commission ideas, and the framework and everything, but are really just giving them the tools to make the decision themselves. Mm-hmm. And when they make that decision, number one, they feel like they're doing it less in the dark. But number two, they know that they made the decision in the end. And so they're going to make sure that it's successful. And there's something beautiful about that relationship and about helping that founder get to where they want to go and still feeling like they did it.
Yeah, it's a major growth opportunity for a founder turning into a CEO, right? That has the experience and has been through the rodeo before. Do you have a program or, let's say, a playbook or a set of things that you help founders go through that growth exercise? They have to grow up themselves as they're hiring new team members and building a bigger company and have more employees.
We think the SaaS CEO is inside of these founders, and we're just helping bring it out, right? And that's our job, as advisors and partners and enablers. We do have things that we have at Growth Street to support this. We have what we call a founder journey, and that lays out how we've seen this go over time towards that life-changing liquidity event.
We're big believers in the growth mindset. I remember 12 or 13 years ago when Nate and I first got to know each other, a friend had recommended to me to read Carol Dweck's book, The Growth Mindset. And I read it and I was like, captivated by it. I wanted to change my whole life based on reading that book. It was so inspirational. And I came into the office, and Nate and I, back in those days, we would play ping pong together. And I told him all about this book. I was like, man, like your mind is a muscle. It talked about the fixed mindset, all this stuff, and jabbering at Nate, just like I'm doing now. And then Nate said to me after about an hour, he was like, I worked in Carol Dweck's lab at Stanford.
Yeah. And the growth mindset for founders, not all founders are like this. We want to change the world. We want everybody else to change, but some founders don't change so much. But as you grow through the phase of growth, you actually have to change yourself. And I used to think this, and now I think that, and build new muscles and all of that. Not everybody's up for that journey. Is that one of the signals you can see that the founder has the growth mindset and is going to be willing to stop doing what worked 2 years ago and figure out what's going to work next year?
This is a Steve term, but we look to partner with learn-it-alls. We feel like at Growth Street, that's what we are. We're learn-it-alls, and we're looking for the same thing in founders. We have found that founders from industry, the profile founder we're describing, they tend to be learn-it-alls, and that can be pretty different than what shows up in the venture world and the venture game,
where you have to look like you know it all.
Yes,
and everybody's playing this, pantomiming this game. Oh, it's definitely. Oh, for sure. Humility is out there. Let's talk about, it's often revealing to founders to hear about the math. How many founders do you talk to a year that could be candidates? And you invest in 2 companies a year. I mean, do you talk to hundreds?
Thousands.
Okay, thousands. You talk to thousands. Okay.
Yeah.
So we're not even saying that anybody listening to this podcast should be working here, right, with you guys, because you're going to screen them out like you're going to co-screen each other out, right, for the ICP kind of fit. But what other characteristics turn out to be good fits for Growth Street partners, either founders or businesses?
Yeah. I think there are like words that we hear that it's like the old TV show with the whammies or whatever. It's like there are words that we hear where we're like, oh no, forget it. And then there are obviously words and phrases we hear where we're like, oh, wow, that could be a perfect partner for us.
What would be the whammy words? It's like a hockey stick, runway,
round. Yeah, or
round.
Right. My favorite question is, do you lead rounds?
Do you lead?
Yeah.
All right. I'm totally confident. That would be another.
Yeah.
So we could have a fun one here, right?
All we need is more marketing dollars.
Just more leads.
Yeah,
we only had more demo requests.
Yeah, exactly. Yeah.
Right. The product is done. How about that?
Yeah, exactly. But the good words, the fun words, actually back to that Milwaukee board meeting.
Yeah.
One of the founders, we were talking through the 2025 budget, and everybody kept saying like, oh, we're only going to burn a modest amount. We're only going to burn a modest, and the founder goes, we're not burning anything. Can we stop using the word burn? We're investing.
Visceral reaction to the word burn.
Oh my gosh.
Maybe one other good example of this too is one of our favorite board slides of all time was a founder that the first slide was, here's what we're not going to talk about today.
Love it.
Yeah.
Yeah, that's we've all seen the turn. We've seen it ourselves. We've seen it in our business. You guys have it as well. When they know, the first move is to figure out what you're not and who you're not on the team and not on the culture. You don't have to be perfect about your ICP or your culture, but you got to be perfect about what's not a good fit. And I love founders who say no.
Yeah, it's kind of the evolution too, where like some founders, they want to do lead scoring like when they're in their infancy, and you're not, like the maturation of the ICP and what is your ideal customer profile, that happens over time. But what needs to happen even earlier is these are the bad ones. These are what I'm not, who I'm not going to talk to, who I'm not going to sell to, who I'm not, no. And actually, it's pretty analogous to Growth Street. Like you asked before, how many we talk to, and we talk to thousands, right? We know early who's a no, and that feels like one of the foundational elements to Growth Street is that like, we feel like we're kind of in the business of saying no.
Well, when you know what works, right? It's pretty uncommon. What is the common expectation? Let's just do the scenario. I bootstrap a business to 3 to 5 million ARR. I partner with Growth Street, take a little money off the table for the founders and a little money for the company to start investing. I get help and start tightening the screws and being a little bit more orderly about things. But I'm at 3 to 5 million ARR. I mean, do you have growth rate expectations that you're going to grow 50% for 5 years and end up in a different place? Or what is the trajectory that you expect that turns out to be good for your math? You want to take that, Steve?
All right. Yeah. So it's a range. So if you're at the lower end, if you're 2 or 3 million in ARR, you gotta be growing pretty fast, 50 to 100% plus.
Okay.
If you're at the higher end, 4 or 5 million, you can be growing 30% maybe. It's about how much net new ARR, you're adding each year. The business has to be working when we invest, right? We're not going to parachute in and help you fix your company. Yeah. In fact, we wouldn't have the first clue as to how to do that. So it has to be working. And then we help you think about how to experiment, how to use the dollars efficiently to be able to either sustain that growth rate as you get bigger or even accelerate it.
And so in some growth equity investors say we expect 3 to 5 times return in 3 to 5 years. What could you say about the expectations, which of course are very different than VC investors would have? Nate, what can you say about that?
We talk about 2 to 6 times in 2 to 6 years. There's no cap on that. Obviously, we've had companies that have been much bigger than that. And then on the low end, we don't want to take things off the table for the founders that we partner with. We want to maintain option value. So if a founder comes to us pretty early in our partnership because there's real strategic interest from a larger company, that can be a perishable moment in time. And for various reasons, that founder may believe that we should really take that seriously. And in the venture world, you can't really take that seriously. The math doesn't work for everyone, right?
Like a quick exit, does it work? It's not big enough yet.
It doesn't work. But in our world, the founder can maintain that option value.
Yeah. And the founder, in your scenario here, the founder gets to decide when they sell, or do you have blocking rights or, some kind of course you have a vested interest in the conversation, but what happens there?
We're aligning with the founder before we ever partner on what we're trying to accomplish together and over
Magic.
Rough time period. Ultimately, what the exit looks like depends on what the founder's looking for at that point, right? And so are they looking to retire? Do they want to continue running the company independently going forward? And if you look at the 8 events across the 7 companies, Growth Street so far, 2 have been minority recaps. So the company's selling less than 50% again to a larger
Founder
investor.
Still in control or the major shareholder?
That's exactly right. 2 were majority recaps. So that would be the SureLink example we talked about. They sold over 50%, but not 100%. So they're just still maintaining some upside going forward. And then 3 were acquired by larger companies in their spaces, backed by growth equity or private equity firms, and 1 was acquired by a public company.
Are most exits these days in your world, which isn't the whole world of SaaS, but in your world, are most of your founders exiting to private equity and private equity-backed strategics like we're seeing in general in B2B SaaS?
It's a pretty even mix, actually. Yeah. So the financial sponsor, private equity firm or growth equity firm standalone is maybe a third. And the strategics backed by folks like that is another third. And then straight strategics, the final third.
And a strategic is a big public company that wants to pull you into their portfolio. It's a big company. And it's less like the private equity game of continued profits and growth. It's more like Microsoft or Google or a major industry player buys you and brings you into the portfolio. Yeah,
we just sold a business, Visual Lease, to CoStar, which is a $30 billion public company. So Visual Lease, we invested 6 years ago or something like that. The company quickly tripled. We did a recap, a minority recap with Spectrum Equity. Yep. The founder took some chips off the table, rolled a bunch, still basically controlled the company. And then a few years later, we sold to CoStar. So that founder got 3 bites of the apple. He took a little bit of money from us. He took a little bit of money from Spectrum, and he took a heck of a lot of money from CoStar.
And so there's kind of an interesting different game going on. The strategics used to buy you and cash you out. That's what I experienced in the old days. But now these founders are becoming investors in the new entity. And that's a totally different game. It's almost like they have to do due diligence on the folks that are, quote, buying them or investing in them. Some founders in this 2 bites partial exit game, some founders, especially older founders, remember the old days where you didn't normally get the second bite. It was an earn out and there was all kinds of clauses. And so there's a lot of skepticism about this. What's your experience these days in your world? Do most of your founders win bigger on the second bite, even though sometimes they sell a majority up front? Or what can you tell founders about what the modern game should look like?
The answer is definitely yes on the second or even third bites. And our hope and our goal with Growth Street is to help founders get to that point faster and with a little less risk.
And I explained to founders, this isn't an earn out. They're trying to take your company. They've invested and they win. You have some really serious people that are investing in you getting a second bite, right? Winning a second time. And you guys are successful. So I guess that means they get a second prize. And let's go back to childcare CRM and Chuck Gibbs here in Dallas. And he brought in Matt Amoya as the CEO because he was the founder guy, the scrappy founder that got this thing built it out of the dirt. And Matt grew it up and it's been rebranded. And I guess there's a new transaction a couple of years ago. So Chuck got his second bite or his final bite or whatever you want to call it.
That's a fun story, actually. So Chuck has been going to Steamboat to ski for decades, right? And so every year he would invite us to go out to ski with his family and some of the leadership team. And we had just done the first bite of the apple, or I should say the second bite with Visual Lease. and we're on the chairlift in Steamboat with Chuck and his wife Nancy, and it's quiet, the snow's falling, and nobody's talking. And then Nancy turns to us and says, "How can we have a visual lease-like event?" And so we kind of laughed about it. And then that night, over a glass of whiskey, I think, even though I don't drink whiskey, we talked about what it would take. What tough decisions would Chuck have to make to get to that outcome that Nancy was pressing him on? One of the things was, hey, Chuck, you're an incredible whale hunter. You can go out and get these deals, and maybe that's the best use of your time. And let's bring in somebody that has scaled a vertical SaaS business before like this. And that's the path to the Nancy outcome. Mm-hmm. And sure enough, Chuck was incredibly humble and very aligned with creating value at the company. And he went for it, and he went all in. Matt Amoya never would have joined the company had Chuck not recruited him aggressively.
Right.
And the rest is history.
Well, can you say, I know they had grown a relatively small company and it grew quite big and rebranded. Is there something you could say about the scale of did Chuck win 10 times bigger on his second bite, or what can you say about that?
Yeah, I would say it was like the business got maybe 5 times bigger, something like that. And the reason why it rebranded was because we went out and did a small add-on acquisition to extend the product. Mm-hmm. And had we not had Matt Amoya and the team that he helped recruit, that never would have been possible. While Matt and his team deserve a ton of credit for that, Chuck, being so humble and caring and thoughtful about that whole process, like, he's the reason why that company was so successful.
Yeah, the founder can decide we're going to do this or we're not going to do this, and they can be stubborn about certain things. So yeah,
yes, he's a learn-it-all, and
that's right.
Yeah, and a great partner. Yeah.
One other way to talk about these additional bites and the success of the founders that we're lucky enough to partner with, and this is something that's really special for Steve and me and all of us at Growth Street, and it's a KPI for us at Growth Street, is how many of the founders that we back end up backing us. And so
investing in your next fund kind of thing,
and investing back in Growth Street. And we've had a number of founders already do that. It's a really good signal, right? That it was economically a successful outcome. They really believed that Growth Street was a good partner and added value to the business. Mm-hmm. And then we really enjoyed working together and we had fun together.
Yeah. And the math works. And let's say in the long run, you can look back 10 years later and say it was reasonably healthy. I had a life. We had some fun. It was hard, just like anything. And we won. And somebody will look, most founders that get through successful or unsuccessful VC funded adventure, unless you're in the heart of Silicon Valley doing it over and over again, kind of say, well, that was not great. I think I would do something else.
Well, yeah, two interesting tidbits there. Maybe I can share the first and then Nate can share the second. But the first one is Mike Martin, who we talked about earlier, the founder and CEO of Hotel Effectiveness. He told us in an interview afterwards, he was like, had I known how much fun I was going to have after you invested, I never would have been so worried about it. And that's like my favorite line ever from any of our entrepreneurs.
Well, maybe that's part of the Growth Street Partners magic. You guys are quite successful, and I know many of your founders like working with you guys. Most founders don't say this, and CEOs don't say this about their private equity investors. It was fun. It was healthy. I'd do it again. I'd invest with you. They're generally put through the ringer there. So thanks for being supportive of the practical founders there. Nate, did you have something to add to that?
No, you talked about the private equity side of it there. We see the same thing on the venture side. We've had founders in the portfolio that prior businesses went down the venture path or went down the heavier funding path. And they decided the next time around, based on some scars and bruises, that they were going to do it the way they wanted to do it. You said we were talking a little bit about increasing execution capacity earlier, and you were like, that sounds kind of boring compared to the venture world, right? And it can sound boring compared to
we love this stuff.
The crazy venture stories out there, right? But it's really practical, and quote unquote boring is pretty darn powerful.
It's pretty darn powerful. Can we talk about it? Let me get perspective from each of you. So founders are growing up vertical SaaS business or niche business and horizontal, and they get to 3 to 5 million, and they're thinking about some exit money off the table, and they're getting offers from people. When should founders not take, let's say, growth equity off the table? I would say, well, do you want to run your company to 10, 20, 30 million, build a senior leadership team, become a leader in your market, right? Have more than 100 employees, create a real factory, right? That has resiliency and will keep going. Does that sound interesting to you? Not every founder is interested in that. I said, well, don't sign up for that if that's not your main thing. You might sell your company or somebody else take over. But what would you say to founders, Steve, about don't think about growth equity?
Well,
If you have a few characteristics.
Yeah, so I totally agree with you that like the ambition needs to be there, that you want to get to that 100 employee company and you want to be the leader in your category and you want to have a team of really talented people. So you need that ambition for sure. Oh man, I lost my train of thought. What would you say to a founder that's you're interested in, you're waving a little secondary in front of them and that sounds interesting. But you say, look, you're a good guy. You've got a successful business. You'll be successful without us. It's probably not a fit. Yeah, sometimes it's a control issue. They don't want to invite anybody else into their decisions. Yeah. So the thing that I would focus on, and it is a ton of fun to partner with us and to grow the company, and we have fun, and the founders have fun, but it's hard work, Greg. Yeah. We tell the entrepreneurs that it's like sprinting a marathon. There's no such like you can't physically sprint a marathon. But you're sure as heck not going to be able to do it if you get distracted. If you worry about your competitor or you worry about X, Y, or Z, like you need to put on your blinders and get to that 100 employee company with the leadership team, like where you've got a mission. Yeah. Because it's hard. Yeah. And they have to be up for that race.
Yeah. That sounds like fun to me and the practical founders I work with. So there's nothing more better than building a team of amazing people focused on a major mission and putting a dent in the universe. So I say tell founders not to give up too early and get out of the game because they can grow into great CEOs and change their whole industries. Nate, do you have anything to add to that? When is equity not a great fit?
Yeah, I think that was super well said. The founder does need to want a partner in the business. And that may be a first for them. Sometimes we come across founders who say to us, like, I have no interest in a boss. We're not their bosses. If anything, it's the other way around. We feel like we work for the founders. They do need, though, to want a partner. Yeah. Right? Want somebody else in the room, want input into decisions that they're making that are still their decisions. Adding a partner and someone meaningful to your cap table it's a really big decision.
Yeah, that's the wonderful balance that you're trying to strike, right? Where it's like, if the entrepreneur thinks of Growth Street as their boss, and so they're waiting around for us to tell them what to do, it's a disaster, right? And we'll try to ferret that out early on before we invest. And on the flip side, if the founder is constantly giving us the Heisman and they're saying, get out of here, I know what I'm doing, get out of here, then that's not good either. But it's the ones where they're nervous about letting you in. They're anxious about it. They're guarded. They're guarded, but they tease out a little bit of information to you and they figure out how you're going to react and how you're going to help them and engage. Those are the types of founders that we can really build great relationships with. And those are the types of relationships that end up leading to really successful companies.
Yeah. And all great CEOs. Founders can kind of do it on their own, in their own head, with their own grit. CEOs get a lot of help. I mean, it's just it's a truism. They buy the best help there is, and a lot of it. What can you say about valuations these days? End of 2024, it's not the bubble time. It's not the post-bubble. You grow these companies to 20 or 30 million ARR, right? By helping the growth game and fueling that, supporting the CEO. What is a $20 to $30 million vertical SaaS company worth these days? Is that like 5x, like 100 to 200 million, something like that, plus or minus?
Oh, sorry.
No, go for it,
Nate.
Steve. Go.
Oh, I was just going to say it's a range dependent on the gross retention, the growth rate, the size of the end market, all these things. If a business gets to that scale and it's still growing at a really healthy rate, and it's a really healthy as 20% plus at that size and scale, and it is generating some amount of cash flow, you're still investing for growth. So you're not trying to be super profitable, but it's generating some. Those businesses are extraordinarily valuable. And extraordinarily valuable is 7 to 12 times ARR, 7 to 15 times if you get somebody crazy. If the growth stalls out before that, you're going to get a more modest valuation. But hopefully with Growth Street, we would help you de-risk that. We'd help you figure out how to navigate that potential slowdown.
Nate, do those numbers make sense to you?
They make a ton of sense. And we often talk about beginning with the end in mind when we partner with founders. And so we'll paint this picture and then work backwards from there.
One thing I explain to a lot of practical founders who get to 3 million, I say, well, if you sold your company now and if you have reasonable growth and retention and a little bit of break even and so forth, it's probably worth 5x, 7x on a good day, something like that. But if you get it to 15 million at the same growth rate, profitability, the multiples are much higher. And you get it to 30 million, the multiples keep going up. So that I got it to 5, I want to get it to 30 is the highest ROI for anybody anywhere in the SaaS business, because you got a higher baseline and a higher multiple as you grow your company. But you got to grow the company.
Yes, exactly. There have been crazy times in the world, 2020 to 2022, something like that, where people were paying absurd multiples for $2, $3, $4 million SaaS businesses. And we had a number of instances where we really liked an entrepreneur. We really liked the company. And by a number, I mean a couple. And the founder would call us up and say, hey, this firm wants to buy us for 18 times revenues, like 18 times ARR. We're $2.5 million growing 50% or whatever. 18. And we say, congratulations, like sell as much as you can. That's wonderful. But as things have normalized, and you get the kind of outcomes that you've talked about, now it gets back to like rational decision making, where it's like, hey, take a few chips off the table, but don't sell the whole thing, because when you get to a bigger outcome, you're going to get valued at a higher rate.
Yeah, totally. Yeah, it's a very practical game, and it's literally the dominant game. Founders should not be expecting to grow to 5 to 10 million and get a 10x cash out kind of game. It just doesn't really happen these days. Maybe in some odd cases. In our practical B2B SaaS land, it's not happening the same way.
It's an interesting dynamic, Greg, where like in the venture story land, that is like plastered everywhere, right? You see it in the papers, on the internet, everywhere. And meanwhile, that's a niche market. The market that you target, the practical founders, that is a huge market.
The hidden majority.
It's enormous. And meanwhile, that's treated like it's the niche market.
And it's where founders are winning in bigger overall.
Yes.
So it's awesome. Well, that's awesome. Any final words? I'll ask each one of you for practical founders out there that are growing and maybe thinking about their eventual one single 2-bite exit, right? Playing this game and exiting in stages. Steve, I'll start with you. What advice do you have for these founders about how to build a business that's going to sustain the gauntlet?
Well, I would say if it's always better to have a partner. Obviously, I'm biased. So whether you have a co-founder or you have an investor partner, it's great to have a partner. It's been one of the joys of building Growth Street is having a Nate as my partner. And when you're thinking about building something and you're thinking about having a partner, that is literally the most important decision that you'll ever make in your business. Choosing to bring on Growth Street or choosing not to bring us on or bring on somebody else, we would encourage you to do an enormous amount of diligence. Research everything about us, talk to all of our founders, talk to all of the other companies, all the other firms' founders, and make a really informed decision, and you'll be better for it.
Awesome. Great advice. Almost everybody in the long run says, I made a decision without getting enough advice and I stepped in it kind of thing.
Yeah, exactly.
Yeah. Nate, how about you? What advice do you have for practical?
Yeah, a couple of things. Maybe first, I'll just echo something Steve said there. Whenever people come to me and ask for advice on starting a company or specifically an investment firm, the first thing I tell them is always find a great partner. So right back at you, Steve.
Love you, man.
The other advice I'd give just for practical founders out there is to just understand your options. A lot of the founders that we talked to, they didn't really know that this option existed.
Right.
They've talked to a bunch of venture firms or they've talked to a bunch of private equity or growth equity firms that are too big for them, not a good fit. And so just understand your options. And that's not to say that will be the option for you, but it's good to know what's out there.
Awesome. And of course, you want to work with founders who know what your game is.
Yes.
And fit it exactly. And founder funding, co-founder fit, the whole thing. So I totally get it. I really appreciate you sharing what's happening in the growth equity game and how you guys approach things at Growth Street Partners. Thanks for being on the podcast, guys.
Thank you for having us on. It's been a lot of fun to watch you and your business grow and the audience grow.
Awesome.
Yeah, what a treat. Thank you, Greg. And maybe a quick thank you to all the founders out there we've been lucky enough to partner with. We got to share some of their stories. There are a lot more that we could share, but thank you to all of them as well.
Appreciate it. Thanks, guys. Thanks for watching this week's founder interview on the Practical Founders podcast. Be sure to hit like and then subscribe to my Practical Founders YouTube channel to keep up with my weekly videos for serious software founders who are building valuable companies without big funding. Check out my blog and information about my Practical Founders CEO peer groups at practicalfounders.com. And follow me on LinkedIn to keep the conversation going. See you next week.